Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. One of the most talked about event for the next week will be the budget. And in today's presentation, we are going to discuss what impact budget can have on Nifty and dollar rupee pair. If we do an analysis of Nifty for last 10 years, we have observed that out of 10 times, 7 times, Nifty has changed the direction after the budget announcement. Let me elaborate that further. So, for example, in 2023, 15 days prior to the budget date, market was moving in a downward trajectory. Immediately after the budget announcement, for the next 15 days, market went up by 2.7%. Only exceptions were in the year of 2022, 2017, and 2014. In last 15 trading days, market has mostly gone up in a straight manner. From 4th June low, it has moved up by 3000 points. Now the question is whether after the budget announcement this year market is going to fall or not. If market is going to fall, then what are the factors which can affect its fall? There can be two reasons why market can fall after the budget announcement. First reason is budget day challenges. We have all understood that there has been a setback for the ruling party in the Lok Sabha election. Because of that, they might come up with a populist budget, and if the fiscal deficit number is on a increasing trajectory, it can create some kind of negative news for the market. Second negative news on the budget day can be any news related to FII investment or capital gain tax which might not be liked by FIIs or investor, that can also create a negative sentiment for equity market for a shorter period of time. Now let us understand what can be second reason for the market to fall. We did an analysis. In the analysis, we have found that on 30th May, FTSE UK का जो index है, it had given a sell signal. On 11 July, Nikkei had given sell signal. On 15 July, DEX had given sell signal. On 18 July, Dow Jones had given a sell signal, and finally on 19 July, Nifty had also given a sell signal in their index. Indian markets cannot be completely isolated from the global market, even though our fundamentals are stronger. We are expecting that Nifty will face a stiff resistance near 24,900 kind of a level, and ideally it should move towards 23,800 to 24,100 in next 7 to 8 trading session. Now let us understand what is the impact of budget on rupee. When we did an analysis on rupee, we have found that rupee does not had that kind of correlation what equity market had. 5 times it has changed the direction, and 5 times it has followed the same direction. Now let us discuss outlook on rupee. Our forex reserve data for the week 12 July was released last week, and our forex reserve have increased by $9 billion. Out of that $9 billion, close to 1 to 1.2 billion dollar reserves has increased because increase in gold reserve. Apart from that, we can say that 6.5 to 7 billion FX reserve has increased because of RBI absorbing all the inflows coming in equity and debt market, either via FII or FDI inflows. In the NDF market, rupee has closed near 83.72 kind of levels. On Monday morning, if RBI does not intervene near those level, then there is 15 to 20% probability that the pair can move towards 83.90 to 84.10 kind of levels, saying that there is 80 to 85% probability that RBI might intervene strongly near 83.70 kind of levels. If that happens, then we can again expect a consolidation phase in rupee, where rupee can move or trade between 83.50 on the lower side and 83.70 on the higher side. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Most of the thin margin exporters are taking costing near 83.50 kind of level. So we will suggest them they can cover 70 to 80% of their exposure near 83.60 to 83.70 kind of level. For remaining position, they should see whether RBI is intervening near 83.70 or not. If RBI is not intervening, then the pair can move towards 83.90 to 84.10 kind of a level. So remaining 20% they can cover near those area. Stop loss for unhedged position remains at 83.50 or costing whichever is higher. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. We have been suggesting thick margin exporters that if they are covering on anticipation basis, then they should cover 60 to 65% of their annual exports between 83.50 to 83.70 kind of level. If they are covering on a order basis, they can maintain 70 to 75% hedge ratio. For further coverage, we'll suggest them that they should wait with a stop loss of 83.50, as there is a 15 to 20% probability that RBI might not intervene near 83.70 level and the pair can move towards 83.90 to 84.10 kind of levels. Now let us discuss strategy for importers. There can be two situations. Situation 1, if rupee breaks the key resistance level of 83.75, then we will suggest importers should cover 50% of their next 15 to 20 days import on an immediate basis. Situation 2 can be RBI defends 83.75 kind of levels. If that happens, the pair can move back towards 83.35 to 83.50 kind of levels, as inflows are expected in last week of July. If that happens, then importer can buy 50% of their next 15 to 20 days import near 83.35 to 40 levels. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.